My name is Marcy Berger, and I'm the Member Services Coordinator here at AFSA. Welcome to Mitigating Risks when it comes to F&I aftermarket products and cancellations, presented by Rich Apicella. This presentation is a part of AFSA's Business Partner webinar series, which allows industry experts to share timely educational topics directly with AFSA members. A few housekeeping notes. To ask a question, use the question box on the side of your screen. I'll read them aloud to all following the presentation. The slides and recording of today's webinar will be available later today on AFSA's website under Webinar Resource Center. Finally, you'll receive a survey after the webinar is over. Please take a moment to complete it. On that note, let's get to the presentation. Rich Apicella brings more than 30 years of automotive and financial services leadership experience to the F&I Express team. As an Executive Vice President, Rich is focused on driving new partners to the company, as well as leadership of our Express Recoveries ancillary product cancellation program. Before F&I Express, Rich was Managing Director for Benchmark Consultant International, where he had P&L responsibility for operations in the Americas focused on helping clients improve operational performance. Rich also served as Vice President of Business Development for Capital One Auto Finance, where he developed auto finance partnership programs with Fortune 500 companies and leading internet properties. As a partner with Deloitte Consulting, Rich established and led their automotive retail practice, where he worked with automotive manufacturers, captive distributors, and mega dealer groups around the world. He also spent 8 years with IBM Corporation, where he provided technology solutions to the financial services industry. Now you have the floor, Rich.
Thank you, Marcy. And hello, everyone. Thanks for joining our session here this afternoon. It's a very timely topic that we're going to talk about. So let's get right into it. A couple things I'm going to cover here. Just a little bit of an introduction to get terminology straight. F&I products go by a lot of different names and terms, so I want to get aligned on what it is that we're talking about specifically today. Talk a little bit about the importance of these products. They're important to consumers, they're important to lenders, to dealerships, and to product companies as well, the stakeholders in this ecosystem. Things that lenders are considering and looking at and grappling with respect to VPPs. Cancellation process itself, which is at the heart of making lenders' jobs difficult in handling and managing these F&I products. So we'll spend a little bit of time on that. Talk about what lenders can do to manage risk and mitigate risk with respect to VPPs. Have some key takeaways, and we'll have time for Q&A at the end. I have 7 slides I'm going to go through. First off, so that should give some time, so stack up your questions if you would, please. I'll also say that I'm not an attorney, so I don't provide legal advice. I'm sure each of you have attorneys and teams of attorneys inside and outside that you work with to help you on this particular topic. And the views here and the data that is presented here is based on our work with some 40 lenders here in the United States. So that's what we're drawing on. Just some terminology. VPPs, voluntary protection products, that's a term that NADA has rolled out for these particular products. They are contracts that are purchased by consumers in connection with the purchase of a lease or a vehicle. So these are products that are offered to consumers in the F&I office, and they include products such as GAP, vehicle service contracts, credit life and disability, tire and wheel products, lifetime oil maintenance, appearance protection, all of these things that are sometimes only limited by the human imagination to come up with these various products. So collectively, we call those voluntary protection products. They're referred collectively by several different names: ancillary products, aftermarket products, add-on products, optional products. So collectively, there's a lot of different names for this group of products, but we're going to use VPP here as NADA does as well. And the third, VPP providers are part of our ecosystem stakeholders, and these are companies that administer these products, the use of these products. So adjudicating claims, performing product cancellations, etc. There's about 500 of those in operation in the United States. Some primary examples are people like JM&A, Allstate Dealer Services, Safeguard Products. So they're known as administrators and carriers as well. So just in terms of terminology here, we're going to refer to them as providers. And because there's 500 of those operating here in the United States, that's one of the things that complicates management of these VPPs and to ensure that lenders can comply with their obligations. And we'll talk a little bit more as we get into the presentation. VPPs are big business. Got a little delay here. And they're not going away anytime soon. So what we've done here is put some metrics up that talk about the market as a whole. There's about 45 million of these products that are purchased by consumers and sold by dealerships on an annual basis. So it's a very robust market. You can see the average dealership income. That's reported to us by F&I and Showroom News Survey, nearly $1,500 of dealership income per vehicle retailed. There are many cases of dealerships and dealership groups that regularly exceed $2,000 in income per vehicle retailed. With respect to penetration rates, they're very high. As you can see, here is some information from the NADA, about 90% new and 73% used penetration rates. And one of the things that's interesting is some of the research that we've done is with the advent of digital retailing, as more dealerships move towards a digital retailing capability, what research is telling us is that consumers that are exposed earlier in the sales process to VPPs and the benefits of VPPs, they have a greater propensity to purchase those products. So we think, going forward, we think that may be enough to move the needle on these penetration rates or attachment rates, as they're sometimes referred to. So those rates potentially will even increase in the future. These products have a fairly high rate of cancellation. So anywhere between 20 and 25% of these products that get purchased by consumers are canceled, and they're canceled for a variety of different reasons, whether it be an early payoff of an account, of a loan, a repossession that occurs, total loss event, the various transactions, various things that happen to cause cancellations. And if you think about it, at any point in time, there's around 150 million of these things in force, 45 million a year sold. Throughout 4 or 5 years, you get to 150 or so million of these products. So you're looking at about 30 million cancellations. So that's another thing that complicates the job of lenders, is just the volume of these products that need to be canceled, together with the number of providers that are out there in the market. They're tremendous complicating factors. And when you look at the economics on the cancellation side, what our database is telling us, and the database consists of some 40 lenders here in the United States, the average refund per account is about $1,150. So that's a pretty significant amount of refund that's due. It's refund that is due ultimately to the consumer, whether in the form of a refund check or a deficiency balance. So it's important. It's a big number, and it's important that lenders pay close attention to that and how they optimize the ability to manage those collections and ensure that they can get as much of those as possible. Here's some considerations that lenders look at, and it's not any different than their normal course of business. There's 3 things really that they're focused on. One is profitability, portfolio growth, revenue growth from higher loan balances, higher income from that, as well as on the loss side, reducing losses by collecting more of these refunds that are due, and having a more streamlined process, which allows then the lender to reduce their operating expense. So there's a profit play on this, a profit impact on this, that if lenders can do a better job of executing management and control of these products, it's going to help on the profitability side. We have a regulatory and compliance piece, which is really, I'm sure everyone on this webinar is familiar with, that VPPs have come under tremendous scrutiny from regulators, not only at the federal level, but the state level as well. And at a high level, there's four things that seem to be areas of concern for regulators when it comes to VPPs. The first would be the actual utility of these products. The second would be disclosures, consumer disclosures around coverages and consumer rights to cancel and so forth. The actual pricing of these contracts and the cancellation process. So those are the four areas that regulators really seem, in our experience, to focus in on, and people like the OCC and CFPB and more states are coming in and getting actively involved in looking at how lenders are managing these VPPs across their business. And third, of course, is reputation. Reputation risk, reputation being paramount to lenders in particular. In this day and age, it seems fashionable in some places to criticize banks. But what I can tell you is all of the lenders that we work with, all of the financial institutions, they all want to do the right thing for the consumer. The challenge is hard. It's hard to do it given the nature of the market today, given the nature of the tools that are out in the market today. So they're trying, and it's hard to do so. Up here, go to the next slide. There is a little bit of delay here. So what I'm going to go through now is the actual cancellation process. I get asked this question a lot of time. How does the money flow throughout the process? I can tell you it's a complex process. It's a process that stinks, really. A process that makes it hard for lenders, again, to fulfill their compliance obligations. So just go through various steps involved. The first starts with the consumers. They're in the dealership. They purchase a vehicle, and they are purchase protection products as well. They perhaps will purchase a GAP contract, vehicle service contract. Dealerships are happy to oblige them, and that's the first financial aspect of the VPP process. Dealerships like these products because they have good, strong gross profit as well. So if you look at a typical GAP contract that sells for $800 at retail, the dealer cost of that product may be $250 or so. It varies on a lot of different factors. So you're looking at a $250 cost and an $800 retail price. So that's a nice gross profit for dealerships. And again, another reason why it's very important to the dealership's P&L. Second piece is that lenders typically finance these products as part of a retail installment contract or a motor vehicle loan agreement. So the money's coming there to finance those products that the consumers have purchased. Next flow of money is what dealerships then turn around and do is actually register these products with the provider companies, the VPP providers. And VPP providers are companies like JM&A, Allstate Dealer Services, Safeguard Products. And what's involved in the registration process is to prepare and file paperwork. In many cases, it's electronic, but in many more, it's still a paper-based product, whereby dealerships have to prepare paperwork, as well as remit the dealer cost to pay for that product to be registered in the product company's system so that a policy now actually exists. So that's kind of the front piece of the process. Then what happens at some point is a cancellation request is made, and this is in response to an event that occurs, as I mentioned previously, an early payoff, repossession, and so forth. That cancellation request is issued to the dealership, typically. They then go and register file a cancellation with the VPP company. They adjudicate that to ensure there is a policy in force, and if so, they issue their portion of the cancellation refund back to the dealership. Then the dealership, in turn, is supposed to take that money and include in it the unearned portion of their reserve, their profit on that particular sale of that product, and issue the total amount back to the lender as the lien holder, and then the lender then issues the refunds to the consumers. So this is at the heart of why it's hard for lenders to comply, because it's a lengthy, very time-consuming process. There are many, many failure points where paperwork can get lost, data can get lost, money and refunds can get lost. And a lot of times, and we love our dealerships, we love them very much, but sometimes there can be bottlenecks in the process. Because what do we know about dealerships? We know two things for sure. One is that they don't really care for paperwork, and they don't care for financial chargebacks. So there are two things that they dislike, and those are the two very things that we are asking them to do as part of a VPP product cancellation process. So what has to be done? And a lot of time is spent by lenders, and how are they dealing with that? How are they helping dealerships with the cancellation process? Well, there's a lot of education that takes place. So lenders are educating their dealerships to say, hey, look, we're being compelled by our regulators to have to manage these cancellations and ensure consumers receive refunds they're entitled to in an expedited fashion. So we need your cooperation to process these cancellations in a timely manner. So there's a lot of education that takes place for dealerships so that they understand that lenders need their help, need their cooperation. That's a big piece of what lenders are doing. Another piece of what lenders are doing are educating the product companies themselves. Because of the nature of the market today, there's really a hands-off relationship between lenders and product companies, product providers. And current state of the market is still largely everything is run through the dealerships, paperwork, and the refund monies themselves. So as lenders educate providers, educate them on the need for them to focus on these cancellations and assist in having these cancellations done quickly and accurately, that's the big part of what lenders do today in an effort to streamline this process, is raise awareness among all the stakeholders that are out there. Lenders more and more are looking to automate these cancellations. So historically, what would happen is a termination event would take place. Lenders would review the accounts that terminated the previous day and identify those with contracts, cancelable contracts on them, that would then initiate perhaps a letter or a fax to the selling dealership saying to the effect, we are the lien holder on this particular vehicle. There was a product that was financed, that we financed. We've terminated this account. We're requesting that you file for a cancellation refund and issue a refund check to us. And historically, that was kind of how the process started and ended. And there may or may not have been systematic follow-up with the dealerships, inquiring as to the status of the cancellation, status of the refund payment. So again, a delay that's introduced in the process when lenders are being compelled to complete this entire end-to-end cancellation process and issue refunds to consumers in a timely manner, i.e. 30 days or 60 days. So to the extent that process can be automated, make it electronic as possible, that accelerates the time frame, and it also alleviates the paperwork burden on the dealerships, the dealer partners, so they don't need to do at least one of the things they don't like to do is prepare and file paperwork because lenders can automate that process and file that cancellation paperwork on their behalf. Some of the other things that lenders are doing in this complex environment is improving on the accuracy of the information. So kind of historically, what most lenders would do is when a contract, a VPP, was to be canceled, they would have a formula. They would have maybe a little Excel worksheet calculator that they would use to estimate the amount of the cancellation refunds. And they would set up receivables and send notices to dealerships, collection notices to dealerships that were based on an estimated figure. Well, an estimated figure is not acceptable when it comes to the requirement to issue an exact refund check to a consumer in the event, say, of a gap early payoff, or to issue a correct credit to a deficiency balance. So using estimates to credit deficiency balances are bad and not a best practice. Or to invoice a dealership or charge back dealer reserve using an estimated refund amount, that's problematic as well. So more and more lenders are going and obtaining this exact precise refund amount to the penny so that they can demonstrate to regulators when they're examined that, hey, here's an audit trail of what I've done, here's how I've obtained this information, here's when I issued refund checks to consumers or credits to their deficiency balances. Because if you look at CFPB's website, they issue supervisory highlights every so often. The last one was issued in March of 2019, and on the first page of that, they call out specifically rebates for ancillary products, where they describe they have examined several lenders and they drilled in on this particular topic, and they determined that the rebates that were being issued by lenders were allegedly incorrect, and credits to deficiency balance were likewise allegedly to be incorrect, and the regulators deemed that an unfair practice. And you can go out to the website, the CFPB website, and see the exact verbiage that they're using there. So accuracy is important. Streamlining the process is important. Timeliness is important. One of the good things in this messy scenario here is that we're seeing increasingly the providers themselves, when they receive a valid cancellation request, are refunding the entire amount to the lien holder, to the lender, and then charging back the dealership on their open monthly statement that portion of the refund that the dealership is obligated. So these providers are learning and recognizing that this is an obligation that their lender partners are facing. By and large, these providers want to have good relationships with their lender partners because they realize without someone financing their products, they'll be out of business. So more and more we're saying it's a slow process, but it's positive development in the market for both lenders and consumers as well, that direct refunds are being made in the total amount to lenders who can then execute their refund process on their end. So we like that. That's a positive development that's occurring. Looking at how you take this and how a lender grapples with this particular scenario, and how can they go about and change, a little delay here. Okay, here we go. 1 second. To look at a total account life cycle. And what I've done here is kind of simplified what is a typical account life cycle. There's 4 basic pieces, as everyone here on the phone I'm sure knows. We have our origination piece, we have our servicing piece, we have our loss management piece, and we have our retention, consumer retention piece to it. Okay, so what lenders are doing are looking at their obligations, looking at their internal processes today, and developing control points within each aspect of the life cycle. And this is the way that they can try to get ahead of this and put some structure behind it, put some controls, put some audit points, as well as put an end-to-end picture so that when they are examined by regulators, they're able to produce information on accounts from beginning to end to demonstrate that they have in fact met their compliance obligations. So if you look at these four pieces of the life cycle, up front there are certain things that lenders are doing with respect to verifications. First is when these loan packages come in, they're looking to ensure that these VPPs, these add-on products, that the forms that dealers are sending in, the actual contract forms, as well as the providers that they're doing business with, are approved. So that's the first piece, is that, okay, these forms and these providers need to be approved, and if they're not on our approved list, we're not going to finance these products. So that's one control point. Second control point is to start to capture this information up front about these protection products. So in today's world, as I'm sure everyone knows here, these contracts come in and line 5 might say $4,000 product, right? With no good understanding and difficult for lenders to determine that, hey, that might be an $800 gap contract and a $2,000 extended service contract and a $500 maintenance plan. So to understand that granularity of what the actual products are up front and who the actual product companies are up front, so that they can take steps downstream to investigate these products, to cancel these products, which today they can't because they don't have that transparency, and lenders are spending a lot of time in their funding process to make sure this information is captured so they'll be able to use that downstream as a better control mechanism. And the third thing is what we call an actual verification. What I mean by verification is that lenders will undergo a process and say, okay, I'm going to wait for 120 days to 180 days after a contract's originated and it's booked. And my expectation is that within that 120-day to 180-day period, that contract, that VPP, will be actually registered in the provider's database. So dealership will remit the funds at dealer cost level to the actual provider, product company. Product company will then validate that submission. They will eventually register that product. So in fact, there is coverage. So the lender can be assured that that $800 gap contract they financed actually turns into a coverage, a policy in the provider's database. Well, an important control mechanism is for lenders to ensure that in fact is the case, and that in fact that has happened. And in our experience, in our database, what we're seeing is anywhere from 2 to 10% of products that are verified in that fashion, in fact, were not perfected and have not led to an actual policy to be enforced. And there's a lot of reasons why that can happen: paperwork errors, training issues, and so on. But again, it's an important control point to make sure that contracts that have been financed do in fact turn into actual policies that are in force. The second piece, looking at the servicing side, is really where the bulk of the cancellation activity takes place. So what are lenders doing in this area? Number one, and a big focus, because there are time pressures and there are data accuracy pressures, is to electronically file these cancellations. So move away from a simple fax to the selling dealership or a letter, U.S. mail letter, that goes out requesting these contracts to be canceled and refunds to be returned. To automate that process using tools that are available in the marketplace to do so. And requesting these cancellations simultaneously, not only to the selling dealership, but also to the product companies themselves. Because what happens in many cases, as a simple example, dealerships say will handle cancellation requests once a month. Okay, so they stack them up, and on the 5th of every month, they'll process all the cancellation requests that they've received. So if you as a lender make a request on the 6th of the month, well, it's not going to be dealt with until the following 5th. So you've already lost a month there in time, and it makes it very difficult to achieve requirements that are being imposed by regulators that says, yes, these things need to be canceled and refunds issued in a timely manner. And having a 30-day delay because of processes that are existent at dealerships make it very, very difficult for you as a lender to fulfill your obligations. Second piece, also important, is that accuracy. So for lenders to actually obtain accurate refund information, cancellation information, directly from the product company. Because the product companies are the only people on the planet that know what the precise refund amount should be. Because they have all of the policy information, they have their cancellation algorithms and formulas. As I'm sure many of you know, these cancellation policies vary by product company, by product type, by state, by date they were originated. Some have zero cancellation fees, others have $25 or $50 cancellation fees. Some use pro rata method, some use rule of 78, some use actuarial methods. So to try to build in all of those rules and algorithms into a system operated by a lender is not practical. So the way to solve that problem is to go out directly to the product companies themselves, obtain that specific cancellation refund information, and then take that back in to your process so that you can credit a deficiency or issue refund checks. Okay, so that's an important piece, again, a control piece, so that then again you can demonstrate to a regulator that yes, this particular consumer received the proper deficiency credit or the proper refund check because the information was obtained, quote, from the horse's mouth. So that's an important piece on controls. Third, on the loss management and the recovery side, you know, it's all about doing follow-ups on the status of the money, so the status of where the refunds are. So to have a consistent follow-up process with your dealerships and perhaps even your product companies. So have an established tempo, and lenders we work with have different follow-ups. Just as a simple example, some of our lenders request a cancellation, and then they wait 60 days before doing anything. So they don't make any phone calls to dealerships or send duplicate requests. They just wait 60 days, and they look at the refunds that have come in. And then on the exceptions, where the refunds have not been received, well, then they go and initiate a follow-up to the dealership, whether it be an additional letter, telephone call, a visit by the field rep that's responsible for that dealership, and they execute their basic collection follow-up model. More and more what we're seeing to that end is lenders debiting reserve, the dealer reserve, to obtain those cancellation refund amounts. So historically, that's not something that banks and independent finance sources did, but more and more what we're seeing in the market is that due to regulations that are compelling lenders to do this, they're finding that in order to get that accuracy and more importantly, to have that timeliness, this is the way that they're going to obtain these refunds so that they can then turn around and take care of the consumer. So a big focus on that. And then the last piece, and this is something that's really kind of new and entering into the market, is how can you turn cancellations to your advantage if you're a dealership? And what I mean by this is something called trade rebates. And a trade rebate, the scenario for this would be as follows. So a consumer comes into a dealership and wants to trade their vehicle in early. So as part of the F&I manager's interview process, they would come to ascertain whether or not that consumer had purchased voluntary protection products when they bought the car in the first place. So if they have done that, there's a potential for cancellations to take place because this vehicle is being turned in early, and as a result, a gap coverage is no longer required. Vehicle service contract, no coverage is required any longer for these VPPs because consumer no longer requires this coverage because they don't own the vehicle any longer. So to have the ability for an F&I person to ascertain this and provide them the ability to go and obtain refund information, again, from these product companies, to be able to go out to Allstate, JM&A, and these other large providers and ascertain, okay, yes, there is a $500 refund that Rich Apicella is entitled to for this gap contract. So at the point of sale, to be able to take these refunds and apply it to a new car purchase to get improved LTVs, improved underwriting for lenders, or to increase purchasing power for consumers. So to turn something that dealers don't like into something that'll help them move more cars. And that's something I think that the industry is going to see more of as the tools evolve and as the cooperation increases between lenders, dealerships, and these VPP companies that are out there. I find I have to click this twice. A couple other things that I wanted to cover here is the evolution that we're seeing in this VPP market. There's a couple of things that we see as we're working with our lender customers. One is around stakeholder obligations and obligations of lenders, dealerships, and product companies. And what we're seeing as we talk to our lenders is that there's a lot of misperceptions that still exist out there. And one of the misperceptions is, okay, I don't need to do anything as a lender because the dealership sold the product and they're required to issue a refund. Okay? Well, that's incorrect. That's a wrong perception to have. That ultimately regulators are looking to the lenders to facilitate that, and increasingly state regulations require that as well. So some lenders still have the belief that dealerships need to issue these refunds. So they need to do some work on their end to change that. A lot of times when we speak to lenders, they say, well, our process is okay. Our internal process is okay, and we feel pretty good about it. Well, what we look at when we go in and you look at the time frames that are required for them to execute those cancellations, you look at the labor and the resources that are required to execute those, and you look at the fact that accuracy is required as well. These are things that some lenders, many lenders, have not really thought through and not really incorporated as part of their cancellation process. So these are things and challenges that they still need to face. Or we talk to credit unions and they say, well, none of these regulations apply to me. And our response to that is, okay, consumers work with credit unions because there's a membership, there's a loyalty, and there's a shared interest and a shared bond that exists between a consumer and a credit union as being a member. So although technically what regulations say or don't say, that's one thing, but the main thing is to do the right thing. To do the right thing for the consumer, to do everything possible that consumers get the refunds that they're entitled to, and they get accurate and timely refunds. And I know every single lender that we work with want to do the same thing, despite what others may say about things that lenders are doing or not doing. They all want to do the right thing. But it's hard, given the state of the industry right now, for them to do that. And that's the fundamental challenge, is working together. And it's as simple as that. And how do we introduce transparency in the market? How do we introduce data sharing? How do we educate all of the stakeholders in the market? It says, look, these are the things that we need to do, or we're being compelled to do, and here's the right things to do. And how do you work together and bridge these gaps to have all of these stakeholders have that transparency, share that data, collaborate on what needs to be done to do the right thing. And at the end of the day, that's what should be the goal, is to work together, to engage constructively with regulators, because what we've seen is the more regulators understand this and understand the steps that lenders are taking, and there are massive investments that are underway inside lenders, to change and to re-engineer their operations so they do the maximum they can to fulfill their obligations and make sure they do the right thing for the consumer. Couple of takeaways, and I've kind of talked about these throughout the webinar here, and there's really a couple things that we tell our lenders. Is number one is understand what your obligations are. So there are federal regulations, there are state regulations that apply, and there are a variety of different stages of understanding. Some lenders are very well versed in this and very intimately involved in all of the details and have very active plans and programs in place to improve their capabilities. Some lenders have some understanding, maybe more at the federal level and less so at the state level. And in others, their understanding is just starting. So the first piece of advice that we give, understand what your obligations are. Second, assess what you do today with respect to your policies, your advanced policies. Do you verify that the products that you financed actually turn into policies? Do you have monitoring of your advanced policies in terms of what your dealers are doing on the front end? Are you capturing this information up front during the funding process so that during your servicing, it makes your life easier? We'll take a look at your current policies, your procedures, your technology, your control points, to have an understanding of that as they refer and relate to vehicle protection products. Seems very straightforward and pretty basic, but deploy some controls, get a good control program together for each of those 4 phases of an account life cycle to make sure you have control points in place that are effective, that create an audit trail so that when you do get examined, if you haven't already, I'm sure many of you have, it's only a matter of time, so that you can have a more constructive review process with your examiners. And matters requiring attention, those of you that have gone through examinations, you know what they are. Invariably, vehicle protection products find themselves to become a matter requiring attention in a supervisory review. So have those controls in place so that you can demonstrate to regulators that you're respecting the regulations themselves and you're also doing the right thing on behalf of your consumer customers. And fourth is take advantage of resources out in the marketplace. So people like AFSA, they have tools and resources and research papers and so on that are available to AFSA members, pretty valuable, and I look at them all the time. NEDA, I mentioned they just came out with some guidance for dealerships around how they should conduct themselves in terms of disclosures to consumers, in terms of consistent pricing across consumers, in terms of cancellations and getting on top of cancellations and focusing on those. So that's some pretty good guidance at the retail level that they've come out with. GAPA, is another trade organization that exists in the market. I'm thinking maybe many of you are members of that, and that's a group of product companies, F&I product companies, and lenders that come together and talk about issues relating to VPPs, and an effort underway in place to have that dialogue exist directly between our lenders and our product companies. So they have regular meetings, they have newsletters, they have very active legal teams that are working with both federal and state regulators on topics related to vehicle protection products. So that's something that if you're not a member, you may want to consider looking at what they do over there. We're 45 minutes in, and that concludes the 7 slides that I wanted to go through. And
thank you, Rich. We have a few questions. The first question is, what is the lender's obligation and responsibility to make sure dealer pricing of products is fair to customers?
So I'm not a lawyer on that, so I just want to reiterate that. What I can tell you is what some lenders are doing, are looking at what's coming across, right, in their advance policies. So I'll give an example of, okay, appearance protection seems to be one that comes under the microscope fairly often because dealer costs of vehicle protection products are typically low. And lenders are looking at, okay, there will be a vehicle appearance protection product that comes across as a $4,000 retail item with a dealer cost of maybe $100. So one, understanding that it's a vehicle protection product, that's the first piece. And then the second piece is understanding how they come across from a pricing standpoint. Those are some areas. It's hard, for lenders to do that because dealerships set the pricing, so everyone knows. But to try to understand more of the details of which of these products are coming in and what they're being priced at and what are norms in the market in terms of pricing for these particular products, that is something that lenders are looking at, how to get the data that's needed to do those analysis. And, it's definitely on their radar screen to get to the bottom of some of that stuff.
Thank you. Another question is, what is your outlook for 2020?
So I think a couple things that I see. Number one is you're going to have 50 states having regulations around VPPs. So there's a majority out there today, number one. And I think number two, you're going to see eventually 50 states get there. So I think that that's inevitable to do that. I think number two, you're going to see better cooperation between providers, directly between providers and lenders. And a tangible effect of that, I think more and more what you're going to see is providers sending these full refunds. Instead of having the money flush back through the dealership, you're going to see providers issuing full refunds to lenders who can then take that into their process and make the consumer whole. So that's going to eliminate a lot of delays, and it's going to eliminate a lot of the leakage, whereby not all of these refunds get fully collected. So that's a very helpful initiative on the part of these providers, again, in an effort to do everything that they can to have those good relationships with lenders, because they know without lenders, they're going to be out of business. So I think that's something else you're going to see. I think the third thing you're going to see is that consumers are going to become more aware of this and the fact that they may be entitled to refunds. So kind of the first evolution of this in terms of communicating with consumers is kind of the typical practice would be an account's terminated early, lender would review the account, determine that, hey, there was a product that they financed that the consumer purchased, and there may be a refund involved. So standard practice would be Lender would send a letter to the consumer, thank you for paying off your loan, thank you for your business. We noticed that you purchased a gap policy, as part of your loan, as part of your vehicle purchase. You may be entitled to a refund, period. All right. So one, there was education to at least a minimal point to the consumer. So what does a consumer do when they see that? Well, they may try to engage with their dealership or the product company directly, and that's a hard thing for a consumer to do. It's a lot of work involved in that, and so on. So regulators look at that and they say, we really don't deem that to be consumer-friendly practice. So our expectation is that lenders should be more helpful in that whole process. So what's happened now, consumers used to get these letters and still do in many, many cases. But now what consumers are doing are receiving refund checks, which is kind of cool, which is in many cases they didn't really expect or know that they were entitled to these refund checks. So by lenders doing that, it's increasing awareness on the part of consumers that, hey, yes, oh yeah, I remember I purchased this product, and oh, hey, I really didn't know that I was entitled to a refund until I received this refund check. So as more lenders are doing that and incorporating that in their process, you're going to have greater consumer awareness, and I think that's going to help consumers as a whole, and I think that's a positive outcome on all the hard work that our lenders are doing to do the right thing for consumers. I don't think they get enough credit from some people in the market as to how hard they're working to try to get this done.
Great, thanks. Another question is, what are lenders doing regarding the dealer's rebate portion when the dealer is out of business or the dealer refuses to pay and there is no longer a lender-dealer relationship?
That's a good question. That happens a lot. A couple things that we're seeing is, number one, lenders more and more engaging with the product companies themselves, right? So that's a wall that used to exist that's coming down. So a lender ascertains, okay, dealership is out of business, right? Or there's no possibility to hit a reserve. So the next step typically, and what we advise, is engage directly with the product company. Because the product company, at least a portion of the refund is the responsibility of the product company. So in that example of that $800 gap policy I talked about earlier, say 250 of it was premium that was paid to Allstate, and so part of that on a cancellation, part of that's refundable. So at least have the ability to collect some portion of the refund, so that's not a total write-off in terms of that refund. So you're starting to see that collaboration directly between the lender and the product company, and that's another example of these walls coming down and transparency being increased. So that's just one concrete example of what lenders are doing, working directly with their product company partners.
Thank you. And the last question, do you typically see lenders reviewing marketing materials associated with products as part of approval to fund these products?
Yeah, each lender has a different procedure that they follow, but the ones that I'm aware of, they look at the contracts, they have to be submitted for approval. So that's a part of it. And I do know some, in fact, look at marketing materials, point of sale materials that are in the F&I office, as part of their forms review. Yes.
Great. Thank you so much, Rich, for sharing your expertise with us. Remember, the slides and recording of today's webinar will be available later today on AFSA's website under Webinar Resource Center. Thank you so much. This concludes today's presentation.